I get this question all the time. Hey Artie, how can I invest $1,000 and make it grow? That's a great question. If you guys are asking that question right now, that means you're definitely moving forward towards success. All right, maybe I don't hear that question all the time. Maybe like once or twice. But the point is, it's a great question to ask yourself. So let's talk about it. Now, there's going to be two types of people asking this question. The first category is you have an extra $1,000, but you don't have a lot of extra money coming in after that. The second category would be a person who has $1,000 today, but maybe in a week or 2 weeks, they're going to have more money coming in. Those are two very different situations. So let's kind of talk about the first one. So you have $1,000 and you want to invest your money. You want to watch it grow. You want to become a millionaire. That's an awesome ambition, and I love that you guys are asking that. So to put it in perspective, let's give you a couple examples to see what can you do with that $1,000. So in 5 years, if you put your money into the bank account and they pay you some percentage on it, your $1,000 is going to become like $1,003 in 5 years. Let's say you put your money into a CD or a certificate of deposit. They still don't pay very much right now either. As of right now, it's about 0.4%. Your $1,000 becomes a whopping $1,018. So you made $18 in 5 years. Well, that sucks too. But if you invest that $1,000 in the stock market for 5 years, you can expect about 50% return on average. The stock market average is 10% per year. So your 1,000 grows to 1,500. So you made an extra $500 over 5 years. The percentage is good, but because you have such a small amount in the market, it's not growing as fast as it would maybe in other places. So what does that mean? If you only have $1,000 today and you're not expecting a whole lot of extra money coming in, the best may not be to invest. You might have a much better return on your money if you invest in yourself. Now that sounds a little cheesy, but let's kind of talk about it. If you take your $1,000, you want to learn a new skill. You buy yourself a camera, a decent lens for about $1,000, and you take a couple classes on photography. And you start taking pictures of people around you, birthday parties or different baby showers or different events. This way you can invest your money into a skill that will make you money. And that skill is going to make you a lot more than $250 in a year. The other way that you can take that $1,000 and make it a lot more in 1 year is the place that you work at, they probably have certifications or different steps or things you can do to increase your income. If you can take that money and get that certification, you'll make a lot more in 1 year than $250 from the stock market. So invest in yourself. Find out how can you grow your income where you're working at. Learn how to make more money so you can invest instead of 1,000, you can invest 10,000. Now 10,000 growing at 50% is 5,000. That's significant. 100,000 that grows by 50% is 50 extra thousand. So you can see the difference. The more money you have coming in to invest, the more difference that'll make. Now, the other thing you can do with this $1,000, take some time and maybe take a little bit of money and research other jobs around you. If the job that you have has a ceiling and you can't really make significant income increases at your job because you're kind of stuck at where you're at, maybe look around for another job. There's a lot of skills that are very valuable in our society today. Maybe you can learn how to design websites. Maybe you can learn how to code. Possibly you can learn some other skill that's very valuable. So learn a skill. It will probably take you some money to learn this skill and some time. Use that skill to get yourself a much better job or become much more valuable in the marketplace. Job loyalty used to be a lot more valuable in the workplace. You'd get reimbursed in vacation time and a lot of other perks. A lot of times, if you keep working for a company, the biggest benefit is they say, hey, thank you, we appreciate you so much, but it's in words. It's not financially compensated. If you have a job that's kind of a dead-end place, get something better. The last way I would take that $1,000 and invest back in yourself is in knowledge. So get some basic books on investing, get some basic books on how to grow a business. Let's say you have a skill already, like coding. You can get some good books. They will cost you money, but you can learn a lot more about coding by having those educational resources. Maybe going on a seminar or possibly connecting with people around you. If there's a mastermind for real estate investing and you know a little bit about real estate investing, that might cost you some money. Let's say $500 or maybe even $1,000. But this way you can make connections and learn a lot more than you realize for that $1,000. The first book that I just love and tell everybody about is A Simple Path to Wealth by J.L. Collins. It's a very straightforward, no BS book about investing for the long term. All right, let's say you now have $1,000 and you have money coming in. This puts you in the second category. This changes things and it becomes a little bit more interesting. So how can you invest your money more consistently starting today? I'm just gonna cover the very basics of stock investing. I have a video about how to open an account and how to start funding it, what funds are great. I'll put it up here in the link above so you guys can check that out if you want to. But in this video, let's kind of cover the basics of investing. So we're gonna talk about from the most passive type of investing first, and then we'll end at the most active investing. You can start with a traditional money manager. Now this usually costs you anywhere between 1% to 2% of your portfolio. So if you have a small amount of money, that doesn't sound like a lot. But once you start having more and more money, let's say you have $100,000 in your account, it would cost you between $1,000 to $2,000 every year just for them to work with your money. If the returns are negative, if the market goes down, they still get paid. So you can lose money in the market and you still have to pay your manager the 1% to 2%. However, a robo-advisor or a robot money manager like Wealthfront, for example, they usually charge only 0.25%. So you'll spend a lot less money in fees. They have you fill out your risk tolerance, kind of your time horizon for your investments, so you have an idea what kind of portfolio you want to have. With a robo-advisor, you just put your money in and you forget about it. You can set up where every paycheck or every time you get money, you just put a certain amount of money into the robo-advisor account. And you don't have to think anything about it. You don't have to watch your investments. You don't have to watch the market. You just let the robo-advisor do its thing. Very, very passive way to invest. The second way that you can invest that's a little bit more active than robo-advisors is buying individual traded funds or ETFs. This can include something like the SPY or the S&P 500 index or Vanguard's VOO, a bunch of other ones like Nasdaq or QQQ. Those ETFs, they track a whole bundle of stocks and you pay a very, very small percentage, anywhere about 0.1% or sometimes even less. So a very small amount to have your money just follow the entire market. So over the course of the last 5 years, this has outperformed robo-advisors by a significant amount. The S&P 500, the 500 largest stocks in America, that is the benchmark that all other funds measure up to, or try to at least, because in about a 10-year period, 95% of actively managed funds will perform worse than the S&P 500. Just because you pay a money manager doesn't mean that you'll do a better job as a result. Now with ETFs, I'll also put in mutual funds. They're a little bit different, but the basic concept's the same, where they have a whole bunch of stocks that you're buying into. Some of my favorite things to invest into are mutual funds. Now, I do want you to be aware, mutual funds have a higher expense ratio, meaning you're gonna pay a little bit more money to own a mutual fund. And the average, that's a decent amount, is about 0.75%. If your mutual fund is higher than 1% or 1.5%, chances are you're actually gonna lose a lot of money that way. My favorite mutual fund is the Fidelity Select Technology and IT Fund, or FSCSX. I kind of put that into a lot of my videos, but the reason why I love that fund is because of its performance versus the benchmark. It has beaten the S&P 500 pretty much over any time frame. I love that fund. Now, this is just what I do. I'm not saying that you should do that, but there are mutual funds or ETFs that you can find that can really grow over time. Now, these different ways that you can invest have different results. For example, in the last 5 years, if you went with a robo-advisor like Wealthfront and you went in their most safe category, you'd expect to grow at about 7% a year. Or $10,000 would turn into about $13,700 over the course of 5 years. Now, if you went with their most aggressive account, your $10,000 would become about $17,940. And that grows at about 12.4%. So that's quite a bit better. If you invested in the S&P 500, like VOO or SPY, any of those indexes, you would have grown 10,000 to about 20,700. So you'd a little bit more than double your money in 5 years. That's a little bit better yet. My favorite fund that I like, the Fidelity Mutual Fund, that has increased about the same as the Nasdaq. So that would have grown to about $31,500. So a little bit more than triple your money in 5 years. Now, you can't always expect to be making that much money in a stock market. The stock market over the last 5 years has just been insane. if you look at the chart, it's essentially been going up, up, up with kind of a few little dips on the way. Even with the COVID crash, that was about like a 1 month down and 1 month and a half, and we were back up to all-time highs within a couple months after a 30% decline. That's pretty wild. What can we expect in the stock market over the next couple years? It's probably still going to meander its way up, but a lot slower and with a lot more volatility. I think there's going to be a lot more choppiness in the markets. So what does that mean for you? If you expect that your money is going to double in the next couple years, it's best to go into investing with a longer term expectation. It's not timing the market, but time in the market. It's not how good you can trade, but it's how long you can put your money to work for you. So we talked about robo-investing, we talked about ETFs and mutual funds. The next way that you can invest is individual stocks. Now, investing in individual stocks, that is a lot more active and a lot more hands-on than investing in indexes or investing in ETFs or even investing with a robo-advisor. This is going to take a lot more of your time and a lot more chance to lose your money. If you invest in the whole stock market and things really go bad and the market falls by 30%, you lose 30% of your portfolio. But if you bought 3 companies and 2 of them go down more than 50% and 1 of them goes down only 10%, you're still going to be losing a lot more than the market. Let's say you're buying Chipotle, but all of a sudden they started selling some bad guac. There was a string of bad guac everywhere, and people started suing them, and all these lawsuits going all over the place, and they end up going bankrupt. What would happen to all your money if you were riding on one stock? So instead of having 2 stocks or 3 stocks, the recommendation is try and have closer to about 5 to 10 stocks, with 13 being the optimal number. But 13 is a lot to keep track of. So if you think you can beat money managers at their own game, it's possible. But the chance of you beating even just the S&P 500 choosing individual stocks, they're pretty slim. There are a couple good books that I've read that got me really excited about picking individual stocks. I'll put them down in the description below. One famous one is How I Made $2 Million in the Stock Market. It's by a guy named Nicholas Darvis back in the 50s. So he took about $40,000 and made it into $2 million in a course of like 2.5 or 3 years. So pretty crazy. Now, how many people can do that in a repeatable basis? So my warning with trading individual stocks is the chance that you're going to underperform the S&P 500 is pretty high. Out of professionals in a 10-year period, 95% do worse than the S&P 500. Are you okay investing that much time and money and possibly still making less money than the S&P 500? If you decide that, hey, you know what, I'm still going to do individual stocks because I know what I'm doing, I can figure out the good deals, there are a couple really good books. The number 1 book that I can recommend about individual stocks is Bill O'Neill or William O'Neill, How to Make Money in Stocks. I'll put a link down below. So that book covers the fundamentals, so how to value a company, what kind of metrics are important, what kind of metrics are not important, and also how to look at technical analysis, and that tells you looking at a graph or a chart of a stock, where's a good place that you might want to buy more, where's a good place where you might want to take some profits off, because maybe there's too much risk in the system at the moment. Those kind of things you can learn on your own when you want to trade individual stocks. Another great book is The Intelligent Investor by Benjamin Graham. Benjamin Graham was actually a mentor to William O'Neill, so there's going to be some similar ideas in their books, but Benjamin Graham's book is kind of considered like the perfect book on value investing. Basically, you're going to figure out how to value individual companies and find out when a company is deeply undervalued. For example, you can buy a stock for $10 for a company and the market valuation for that stock is $1 billion, but they have like $2 billion just in cash. They have more money than all the valuation in the stock market. That would be called deeply undervalued. And if you really dig in a lot and look around for opportunities, you will find these opportunities. But I want you guys to understand, if you invest in a deeply undervalued company, that means that company is not liked very much. It might take 2 to 5 years for the market to catch up. So you can't expect to make quick money doing value investing. And if you're not patient enough to wait around that long, I probably wouldn't recommend investing into individual stocks. All right, the fourth way, the most active way of investing is called trading. So when you invest in value companies, you're still investing over the term of like year to 2 years to 5 years. But trading is a lot more short term. You can trade for a couple weeks, you can trade for a month, or maybe you're trading for 6-month period at a time. So if you're gonna start trading individual companies, not only are you gonna have to understand the company, not only are you gonna have to understand the fundamentals and the technicals and the whole thing about individual stocks trading, but on top of that, you're also gonna have to really study the psychology of the market and trying to be on top of each move in the stock market. It takes a lot of time. I tried it for a while, didn't work out for me. Now there were 2 companies I made a ton of money on. It was BioLife and Tandem Diabetics. They made me a lot of money. But all the other 15 companies that I had traded had actually lost me more money than those 2 companies made me. So if you can't honestly look at your portfolio and you can't see, oh wow, I've won so much in this one stock, but overall you're actually negative in your trading strategy, if you're not able to do that and put your ego kind of at the door, it's probably best not to trade individual stocks or even try and buy individual stocks. Go with the ETF route. The other way that you can trade that's not quite as intense is trading the market as a whole. When the market crashes 30+% like it did in COVID, what I did was I took money against the house and I put it into the stock market itself. I didn't look for individual stocks, individual companies, because that's a lot of work and I'm not as smart as a lot of hedge fund managers out there. But I was able to put money into the stock market right after COVID and I went pretty aggressive. So some of the funds I had were ETFs that were like double funds. And my money has multiplied by 5 times from the low of COVID. Now these opportunities are not always there. They happen every couple years. The big ones happen about every 5 to 6 years. We had a huge one in 2020. That was kind of once in a decade opportunity to just invest a ton of money. The one before that, 2018, we had a little correction. 2015, we had some corrections. And then the big one before that was 2008. So the big crashes that happen in the stock market, instead of getting scared, that's an amazing time to start trading. You don't trade in and out of the market. This is when you basically try and buy in as much as you can as the market's turning back up. Those are opportunities that you really want to learn how to take advantage of because they will make not only 50%, but they could make 500% for you. Well, that was a lot of stuff that I said today. So to kind of wrap it up, if you only have $1,000 to your name right now, and that's the only money that you have that you want to invest in yourself. Figure out how can you make your income more so you're going to have other money coming in that you can invest later. So don't just take that $1,000 and expect miracles from it. But if you can learn how to make $1,000 more every month, you're going to take that $1,000 and make it $12,000 in 1 year. But if you have money, you have that $1,000 and you have money coming in, then learn to invest. The best way to invest is ETFs or mutual funds. Don't worry about market timing, just consistently put money in and it's a guaranteed way to grow your wealth. The way that I grew my wealth over the last couple years is through trading, not the individual stocks, but trading the stock market. If the market takes a big dip, that's when I buy in as much as I can. I don't know when the top's gonna be. I can't time that. But if the market crashes, that's when I'll try and get as much money as I can and put it in at the bottom. So as always, I wanted to just show you guys my Roth IRA. I'll pull it up here on the screen. So over the last couple years, my Roth IRA went from about $20,000 to a little over $100,000. Today, it's at $107,277. Just the fact that you guys are watching videos like this means a huge amount for your future success. The way that you can open your mindset to what is possible, that is one of the biggest ways that you can change your financial future. So as always, I appreciate you guys being here and spending your time with me. If you guys appreciate the video, give it a thumbs up, share it with a friend. So hopefully you learned at least something in this video today. Time in the market is a lot more impressive than timing the market. So thank you guys for being here with me. Wish you well. Love you all. Thank you for your support. For everybody who's subscribing and following and hitting those like buttons. I love you guys. I owe a lot to you. Thank you very much. See you next week. Artie out.